Hello, I'm sitting with David Goncalves from the Vine Group. He is one of the founding partners at the mortgage brokerage there. Welcome, David.
Thanks for having me.
It's a pleasure. It's a pleasure. Um, I wanted to ask you briefly about your company. You have a mortgage brokerage. Could you tell us a bit about the company itself?
Yeah. So look, we started this company 10 years ago. It was just four guys in a dream. you know, the goal was to start a firm that was a little bit unique, a little bit more boutique in the sense that it offered a very polished type of service and experience for customers because we all came from the bank and we had that type of training. But, less of the bureaucracy and a little bit more focus on really giving advice and solutions.
So it's interesting because you're saying about giving people service. Most people, when they're dealing with their mortgages, find them more like a transaction
Mhm.
than they find it a service. What do you mean give them a service?
Yeah, because, we wanna be in the advisory business, right? We always say that, our motto is that we're in the people business. We just happen to do mortgages. And really what that means is we wanna listen to the customers. We wanna basically understand what their goals and their objectives are. We wanna make sure we have a good line of sight as to where they wanna take their investment in this property. Because let's face it, buying a home isn't just a roof over your head, it's an investment now, right? It's part of your estate planning, it's part of, your long-term, obligations, for the next 20 or 30 years, you're gonna have to be probably dealing with that mortgage. And people are so focused on the transaction that they forget that the impact of this is gonna be a lot greater, for them. So we try to touch on those points about what the next 5 or 10 years are gonna be like. We also focus a lot on being very proactive rather than reactive. At a bank, they're not designed to be proactive. Nobody at the bank has a role where they proactively call their customers and say, "You know what you should do with your mortgage? You should break it and then float down to a lower interest rate so you can save some money." It doesn't exist in the
Mm.
bank.
Or even bring it to another institution that's got better terms.
Exactly, right?
Yeah.
And look across the street, there's a better option there. We do that part. So we have that conversation. So we're always proactively looking at what's going on in the marketplace. We're tracking bond yields, we're talking economic reports, we're listening to what the Bank of Canada is saying and not saying. We want to see what our neighbors from all across in US and Europe and how things are in our economy is evolving. So we have a good pulse and understanding of rates are going up, are they going to stay relatively flat, or are they going down? And then we'll proactively engage our customers and give them advice based on that moment. But not just at that point of that transaction. Things sometimes come and interfere with that plan. Look at the last 10 years, 2020, right? March, COVID. You know, I was literally on a plane, getting on the tarmac of the Pearson to go down south with my family for March break. And I get the call from the office saying, "We got to lock down the office and everybody home."
Mm.
Right. So I was like, "Okay, what's going on here?" When I take off and I land, I look at my phone and the bond yields are all inverted. And the
Mm.
first thing that hit me was, I've seen this before, credit crisis. So if history repeats itself, which usually it does, rates are going to be coming down. And we had just had a whole bunch of clients starting to lock into fixed rates because rates were on the rise a bit.
Mhm.
So we did the math real quick to get I mobilized my sales team and we reach out to all our customers. They're like, "Look, if we're right, you're going to be really happy that we're going to basically secure a variable rate for you. We're going to hold that for the next 90 days. And if rates are coming down, you switch out of that fixed rate back into this variable rate and you will ride this wave downward." Again, no lender is going to do that. When
W
rates are on the rise in the last couple of years, we took those same clients on the variable that went to 1.5 and 1.8. And we said to them, "Guys, look, rates are starting to rise now. So as silly as it sounds, because your rate's 1.8 and I'm saying let's hedge a fixed rate at 2.2, if I'm right and rates start rallying up, because what I'm hearing from the Bank of Canada, we're hearing from the economists, is that inflation is turning its ugly head. It's catching up with us now." Sure enough, rates started moving and a lot of our clients started locking in their rates. So they avoided this entire rally of going up to 6.5 on the variable rates because we proactively advised them. And in this whole journey, we're saving them thousands and thousands of dollars. And now those clients are coming up for maturity because we put them into 3 and 4 year terms. They're coming to maturity this year, next year, and we're able to now take advantage of this rate environment. Rates are now starting to slip downward again, right? And that is the difference between an advisor Huge difference between an advisor at Vine versus your typical banker or even the typical broker, unfortunately, who's just looking to transaction and move on to the next deal.
So basically, there is a way to actually proactively manage your mortgage, much like you might manage an investment. You're managing your lending and your borrowing in the same way.
Yeah, you're managing it, right? And I think a lot of times when people think about debt, mortgages, they think about interest rates. I rather look at it's not so much the interest rate as much like interest you pay, right? And those are two very distinctly different things. So rather than looking at, like, if you look at that journey, for example, that we always had the best rate at every single point in time? No. But because we were proactive, our clients average out at a much lower cost of funds than the ones who rode the variable all the way through or locked in and stayed there and didn't take advantage of the variable coming down. So the way I look at this is as because we're advisors, because we're tracking it, because we're monitoring it, just like you would an investment portfolio, we're doing that with your credit. We're giving an opportunity to have professional advice and guidance throughout the journey. Guidance that I don't think a lot of people even realize they need or is available to them. But we are proactively making it available because the customer's not going to come to me and say, hey, my mortgage is fixed, rates went down. Like, what do I do? No, we're proactively going to them and saying, we ran the math. We can save you $10,000 right now.
So one of the things that you mentioned was the managing the credit, right?
Mm-hmm.
But then the other thing that makes me think about is actually managing your own credit, like your credit score.
Mm-hmm.
I know that when you're doing a mortgage, oftentimes you have to go to the person that's going to lend money, the company that's going to
Yeah.
lend the money to you, and say, these are my assets, these are my liabilities. And then they're gonna qualify you. Okay, you do qualify for a mortgage with us as the
Mm-hmm.
lender. One of the things that I found really interesting is that different lenders will qualify you for different terms and different policies and different amounts
Oh, yeah.
with exactly the same numbers. Could you talk about that?
Yeah. So different lenders have different criteria, right? So look, the day of everybody kind of fitting in the box perfectly has been long gone for probably like the last 15 years. Um, I find the majority of transactions, doesn't matter if you're high net worth or if you're a first time buyer, if you have great credit or if you have bruised credit, everybody has a little bit of an exception required to make the deal work. And that's really where the magic happens. All the lenders work in that environment where it's like, hey, we're almost here. There's something just a little bit outside the box. How do we mitigate that to justify the loan now? The thing is, when you're looking at that, each lender has different criteria. Some lenders will lend a lot less because they're not looking at your true capacity. You're not looking at your true net liquidity.
Mm.
And they're just looking at the income that you file in your T4. And if you're self-employed, you're probably not filing 100% of your income in your personal tax because you're
Yeah,
self-employed, so you can avoid paying a ton of tax, right?
yeah, yeah.
So in that case there, Bank A might say, hey, I'm going to give you whatever, let's say $1 million. Bank B says, well, you got $3 million of liquidity. I can actually take that into consideration. And now, plus your income, I'm going to give you a loan of up to $2 million.
Mhm.
And they're both big five banks.
Yeah, yeah.
Just slightly different policy. And the policy will change at time depending on the bank's tolerance and their risk and their own balance sheet. So as a broker, we have to be on top of that. We have to be constantly watching and seeing where the bank's policies are and how are they tweaking and changing those policies. The banks want to lend out money. They want to give consumers the opportunity for home ownership. No bank comes out here and says, I'm not in the business of lending. Quite the opposite. But their balance sheet and their level of risk tolerance may restrain their ability to do a specific segment of borrowing one time, but doesn't mean it's going to be like that forever. 6 months from now or a year from now, they'll review their policies or review their balance sheet, and all of a sudden they're lending, with a little bit more aggressively, if you would, or a little bit more of an exception by using other things like assets and liquidity,
Yeah.
because things have changed. But if we're on top of it, we're always watching it, we know what's moving on. And that's why a lot of our clients, we have to move them from one lender to another in order to get them the best and most opportune options. Like to get the best options and give them the ability to maximize their savings through the journey of their mortgage, we may have to move them a couple of times because no bank will be the best option all the time. That I can guarantee you.
Yeah. One of the things that I always found interesting when I worked at one of the big 5 banks,
Yeah.
um, what I found was that this bank in particular really wanted you to have income.
Mhm.
They didn't really care so much about the assets that you owned. So again, if you've got a corporation with tons of assets
Mhm.
or, you have a trust with tons like, well,
Mhm.
the trust wouldn't be yours, but if you had a another place that had lots of assets, or
Yeah.
even if you had lots of, investments that you didn't wanna break because of the capital gains, um, they wouldn't lend to you unless you had a level of income.
Mhm.
Um, and then you had other banks that cared more about the assets than the income.
Yeah.
So that's interesting. But the other thing that I found interesting is that once you start getting too many properties, so for example, if you
Mhm.
start investing in properties
Yeah, yeah.
rather than stocks or bonds, that you'd end up finding that the banks would not want to lend to you, or that they would lend to you with higher and higher interest rates. Could you talk about that a bit?
Yeah, investors are like the professional investors, if you would, that want to build large, portfolios of real estate, are quite the breed because they're really great at like analyzing the asset they're going to buy, the cash flow. They're making sure that the demographics make sense with their objective, the vacancy rates. They are super on top of everything. But when you ask them, well, about the lending, they just assume that every lender is going to lend the same way.
Mhm.
And that's so far from the truth. If you want to build a portfolio of for real estate, and you're going to obviously have to leverage that real estate, you need to know which lenders lend best at what time. There's lenders in our market that will only lend to you on your first 2 properties. That means if you own more than 2 properties, they won't lend to you. There's lenders that have global limits. So you have 4 properties and their global limit is 4. Guess what? You got 0 mortgages with them and they still won't lend to you.
Mhm.
But there are other lenders that are very easy to work with. And they're like, hey, you can have 50 properties. If they cash flow and their debt coverage ratio is within their guidelines, we will keep lending to you another 5 or 10. So when you're looking at that landscape, you want to use the most restrictive lenders really early in your process. If your goal is to have more than possibly 10 properties and you want to have that available to you in the future, you want to start with those lenders. You need to know when to refinance those properties so you can access the capital to keep you on your journey. And then you go to the second tranche of those lenders that are, that 4 global door policy or 5 global door policy. And then you go to those less restrictive lenders, which is only like really one right now in Canada that stands out as a total DCR debt coverage ratio lender on a portfolio of any size. You want to save them for the end. So this way you have a ton of bandwidth you can grow. Look, and not to like, I understand that the banks, like, they're selling their product and they're never really telling customers how it is that they're lending. They don't tell them the rules and the regulations. They don't tell them about the lenders' limitations with their policies and procedures as to how they're going to lend. They don't explain to you how credit is underwritten, you know. And I think there's two. I think there's one, not everybody really understands it, and B, there's no advantage and it's pretty complicated, so there's no point in having this conversation. So what they'll do is they'll keep lending to you and they'll get as many exceptions as they can until they hit a wall. And we did a lot of consulting over the years and speaking at real estate forums with investors, like 700 investors in the room. And at the end, when you come off the stage, there's tons of them lining up to say, I hit that wall.
Yeah.
And nobody told me it was coming. So at Vine, we actually have a blueprint. We call it the blueprint, and basically what it is we analyze every single lender within our ecosystem, all their policies, and we put it together like a puzzle. And we know which lenders we want to start the journey with because they're great to deal with and they're going to have favorable terms, but they're going to be really difficult down the road. And we know which lenders we want to leave to the end of the journey. And then when you get to the end of the journey of residential lending and you've kind of exhausted all the lenders, we have a structure in place where we can take your entire residential portfolio, put it into a commercial blanket loan, and start the journey all over again on the rest side. So we have clients who have 50 properties on the rest side and have never really felt constrained But then I've talked to clients who've had 5 properties and hit the wall and have to start all over again.
Yeah, it's a really frustrating experience for a lot of people, in my experience, when we would go to the bank's lenders and they would try their best to try to help them qualify, but they couldn't. And then they just felt like, I can't do
Yeah.
this. And then they give up on the whole process. And that's one of the things I appreciate about working with the guys from your firm is that they're really thinking about it from a much higher
Yeah, that's
vantage
like what
point.
goes back to the whole conversation about advice, right? We wanna be advisors. We wanna analyze the market, and we wanna plan and strategize in advance. I always tell investors, it's like, financing should be part of your business plan, because if you can't secure financing, you'll never be able to move forward and actually fulfill your objective of investing in real estate, because financing goes hand in hand with real estate.
So one of the things that I find really interesting is that I look at the mortgage agents from your company that I work
Yeah.
with, like planners themselves. That we work in coordination because what we do here is we try to make an investment plan for people, and a lot of the information that you guys need as mortgage brokers is the same that we need
Mhm.
as financial planners, and with when you're planning for the mortgages, you need to make sure that your finances are in order so that you can get your next financing. Um, what we also find is that people's plans change and evolve over time, and it's really great to be working with people that understand that concept, that you're not just talking about one transaction. You're talking about a relationship that can go across years. Um, and what we also find is that people evolve. As they evolve, they start having different lending needs or different borrowing needs, excuse me. Um, do you find that do you find that people change and that their borrowing needs change over time?
Oh, yeah, in a big way. So I've been doing this for 20 years now, right? So I've seen clients, I've had clients, some of them the whole entire journey. So yeah, so people's lives change. Sometimes it's planned, sometimes it's not. Sometimes it's the better, sometimes it's the worse. But I'll use an example of, a very typical example is somebody who's, obviously doing quite well at work. They're getting promotions, their income is increasing. So their goals and objectives start changing. Now because we're very proactive and we're constantly engaging and we're trying to stay top of mind, it allows us to have those conversations as they're going through those journeys. When somebody who sees a big increase in their income all of a sudden through their hard work and efforts, and now looks at the world a little bit differently. And now that, maybe it's time to upgrade that primary residence or do a major renovation and build that forever home or buy recreational property up as a cottage, for example. So you see these lifestyle changes occur, we've had people who were like, the conversation was, I want to put my kids in private school now. Right. But I don't know if I can, like, I'm not quite sure if I'm planning for this properly, you know, how do I manage this? And sometimes it's very simple. Sometimes it's just restructuring a mortgage, reducing the payments so their cash flow allows them to do those extra things that they want to do. Other times it's extracting equity out of their home, so they can go in and they can upgrade, or they can do that renovation, or they can invest in that cottage, you know. Um, but yes, I would say for sure, a lot of people, as their life evolves, the way they look at the world changes and how they want to invest and how they want to spend their money completely changes. And that's a big part of us coming in now and saying, okay, well, we can help you achieve that dream and that goal. And then working with an advisor, if they have an advisor like yourself, that makes things even a lot easier because now we can engage because we're not experts in everything. We can help navigate the credit. We can help maximize that opportunity by taking that restructuring and so forth, but we're not the tax experts. We're not going to be able to do all the other planning behind the scenes. So having an advisor, because we're working with the same client and we're all hearing the same conversations, we understand the client's goals and objectives. Now there could be a collaboration. And that collaboration is hugely important because it allows us to stay on the right track and not deviate. Our efforts don't interfere with your efforts and vice versa. So the customers, who is ultimately the person that we're trying to make sure it has the achieves their goal and objectives, is guided down the right path. Um, and yeah, because people will sometimes, make very knee-jerk knee-jerk the decisions. But if we have this conversation, that can be calmed down, and then it could be structured.
Yep.
And you guys save people a ton of tax by doing that.
Yeah.
A lot of people don't realize how much they can use credit and how that can help actually reduce their tax burden, by accessing capital rather than selling assets, right?
Yeah.
To achieve some of those dreams. And then you have people who get divorced, and and that's something like I had recently. We had a client, they're getting divorced, and they made a decision. But their big stress point was this house. They're like, we plan on selling the house, but the market had just turned, and they're like, now is not the time. What do we do? So we actually took a look at their mortgage. We did a penalty calculation, and we analyzed what their penalty risk is, because penalties are not a fixed thing. They go up and they go down. So we took a look at their penalty, and we realized that, look, for the next 3 months, unless something catastrophic happens, your penalty is pretty manageable. After that, there's a high probability your penalty is going to start skyrocketing. So instead of costing you $10,000 to get out of this mortgage, it's going to cost you $30,000 or $40,000. So what we did is we ended up advising them, to take that mortgage, break it now, and then put it into an open facility so the payments were more manageable for them. And this way, they could just take their time and wait out the market. And when the time was right, which eventually it did, they were able to sell that property and not have this big balloon penalty that would just keep kind of growing and growing and growing. If they hadn't engaged us, and we weren't being proactive in engaging them, and if we hadn't done that analysis, their penalty could have cost them $30,000 or $50,000 more by the time it was said and done. What a waste of money that would have been, right?
So that brings us to penalties. When you are writing, getting mortgages for people, how much do you consider penalties, and how much do they differ from one institution to another?
Yeah, so they can be quite different from one institution to another, right? Like variable rates, for example, there are some of the big banks who do the penalty off the prime rate. So those penalty, and the other banks will do it off the actual interest rate that you're paying,
Which might be prime minus.
which is usually prime minus, right? So if you're prime minus, and the other institution is rolling up all of them back to prime rate, their penalties could be between 10 and 20% higher.
Hmm.
So that is a big factor. IRDs, interest rate differentials, are basically have to do with the discount and the time remaining in your mortgage versus the discount and the term you originally got.
Yeah.
Those penalties can also be quite impactful, and people don't realize that time has a huge role to play in that. So as you kind of get into like a midterm, for example, and they're comparing your penalty and your discount from a higher interest rate to a new rate now, your penalty can actually be going up very fast and very quickly. Every time the bank changes their posted rates, your penalty will change. People don't realize that there was actually an article just written. We won't name the bank, but it was a big 5 bank, and the whole thing was about how they did a very unprecedented, aggressive increase with their posted rate out of their natural, normal 10 to 20 basis points that they would normally go up. And all their penalties, like people's penalty literally doubled instantly, just like that. Your $5,000 penalty turned into like $9,800 or $10,000, like that. So we always look at penalties, and we say to customers, like, look, you have to ask yourself, what's the probability of you staying in this property, like honestly? And if you think you're going to move, then we have to be conscious of having something in mind with penalties, portability, with the mortgage. If it is a major life event and it's something that you can't control, then what we want to do is we want to minimize the impact, and calculate what your goal is. If you're going to sell this property and exit, figure out what the penalty is today, and can that penalty go up or down, and what action do we take now to minimize the impact of that, right? And so maximize the profitability for the consumer. So but we do definitely look at penalties, and we always look at kind of comparing lenders to lenders. And when you're comparing 2 lenders, I think those are one of the factors that people don't usually ask for. But, at Vine, we always try to put that in front of them and say, look, if we're comparing apples to apples, but this lender has slightly better terms historically on penalty, then take the extra win and take that opportunity, right?
It's interesting because people don't understand how much nuance there is in the mortgage market, and a lot of people, again, they go in thinking rates. They go to their one institution as I deal with, and then they do a transaction. right? They don't understand a lot of the nuances. Um, if we are to peel the layers off of the onion just a little bit, sometimes there are certain special situations that you might run into. We had one of our clients want to build his own home. So he had a piece of land. He wants to build his own home. The land is worth something, and as the house gets built, the values change. But he found it really difficult to get borrowing, and it wasn't until I introduced him to one of the vine brokers
Yeah.
that he was able to say, "Hey, look, you know what? There's this place that has this option. There's this place that has that option." Was able to set him up very, very well. Could you talk just a bit about if you want to actually build your own house?
Yeah, construction financing. So number one default product at the bank is construction financing. So guess how the banks feel about construction financing? If they know that the probability of default is higher than anything else, they tend to be a lot more conservative. So when it comes to construction financing, I think what people don't realize is because the risk is so great for the bank, let's look at it from the bank's point of view. You have a law, you're going to knock down a house. Typical process in you know, Southern Ontario, right? In a lot of the big cities in Canada, you're going to knock down the house, the property actually devalues now because there's no dwelling on it. And now you're going to start building on it, which is great. So you're going to dig a hole in it and you're going to start putting concrete in there and you start building. But if you don't finish the project, what do I'm with? I'm with a skeleton on an incomplete lot. So who's going to buy from you now as a lender? Foreclosing on a property like that is a nightmare. So the lender looks at that and says, I need to make sure that you have not just enough capital, a surplus of capital. Because when you build a home, what happens with budgets? Everything goes overruns. So most lenders will add about a 10 to 15% overrun, right? But they also look at that and they go, well, if there's an overrun, there's risk that the person who's doing the construction, that there's an issue with, like there's a conflict with them, they run off, they don't finish the project properly, and now you're stuck because you gave them deposits and that money's gone. So the banks look all these different risks that they can't control, and I think a lot of consumers don't realize is they get an estimate from somebody who's going to do their work for them, and they're asking for draws on like a set schedule every 2 weeks or every month or whatever. Well, the bank won't do that. The bank is like, I will give you the money and I'll release the money after the equity has been created. You pour your foundations, the value goes up, I will give you the money for the foundations, less the 30% you have to put in or 20% or whatever the case is. They're always behind. They're never ahead of the schedule. So as an individual, to get a construction financing at a lender, you need a lot of capital. Generally speaking, you need about 35 to 40% of the capital upfront. Otherwise, you won't be able to secure proper financing at a regular bank. So a lot of people turn to tier 2 financing, what we'll call private equity. And there's a lot of great firms out there who specialize in this. Not every private lender out there wants to lend to construction because of the risks. But the ones who do tend to do a very, very good job of it. And they're a lot more relaxed about their schedules. They're prepared to work on real value, on a loan to value that makes more sense. You maybe have to put in 20% of the capital or 25% of the capital. And then they'll follow you along your journey. The interest rate sometimes seems a little bit higher, but the reality is the ease to capital, the process is a lot smoother. There's less, when you get to the final product, as long as we have a good exit strategy, we can go back to the bank with a traditional mortgage. We find that is actually more cost effective to use that strategy than try to go the other route.
So that's what my client found as well with the borrowing, that everything was so much smoother, that the experience was way better through going through you guys. To that point about strange situations is corporate borrowing. When you want to buy, say, you want to buy a commercial property. What's the difference between buying a commercial property and a residential property?
Commercial properties. So the key difference between commercial and residential is very much based on the individual. Even though the asset's secure, we're securing the loan against the asset, but they're really lending to the individual. So they're looking at you and they're analyzing you as an individual borrower. And then the secondary thing is the property, right? Because residential real estate is considered relatively low risk as an asset class. So the borrower is the risk. Let's analyze the borrower. That's why we need a lot of documentation. And then they'll look at the asset and go, yeah, okay, yeah, this makes sense. This house is livable and so forth. Commercial is usually asset driven first. First is the asset. They look at the asset and they're like, does this asset make any sense? Is it marketable? Does it make any sense in what it is that you're proposing to me that you're going to use this asset for? And then they look at the borrower, right? And when they look at the borrower, they also want to look at your corporate, structure, your ability to obviously pay back on the loan. So when it comes to commercial on a commercial asset, it's generally asset driven. And then if you're going to buy this asset as owner occupied, then it's going to be your balance sheet and how your balance sheet can support that. If it's a cash flow property, but that's a commercial property, then they're going to look at the property, the tenants, the leases. It could be commercial leases, it could be residential, multi-res property, it doesn't matter. But they'll look at basically what their cash flow looks like. Is it reasonable and sustainable? Like if you got a tenant in there who's paying this huge premium, and like for an office, for example, and offices have come down a lot and leases have come down a lot, they're going to be like, no way this tenant's going to renew with you. So they're going to downgrade that. But you might have a great tenant in there that has a long-term lease, like a Tim Hortons, that is never going to leave, right? And it's going to hold that asset. It's going to create a lot of stability, right? And it's going to allow you to tenant the rest of the property, at a higher premium because of that foot traffic that it brings in. So commercial those are the two real big elements. Commercial is very asset driven, and residential is individually driven. The one thing I think you like, kind of a segue from this, is a lot of commercial investors or business owners will want to buy residential real estate as an investment in their corporation because they like the asset class and they want to hold it under a corp. That becomes a lot more difficult. There's a lot of lenders who won't lend to a holding company.
Hmm.
So there's a ton of red tape that can occur from that. And unfortunately, not always are the borrowers informed the lenders of restrictions, and they're trying to push for exceptions. So ideally, you want to do is, again, it goes back to kind of knowing the lender environment. As a broker, we're able to take a look at the whole segment and identify a lender that meets your needs. And a lender who actually allows that to occur and will allow you to keep adding to your portfolio if you choose to in the future within that same structure at ease, right? And balance it from your balance sheet and the rent roll. If there's a rent roll in that property, they'll also use the rent roll. So yeah, it's commercial is definitely a different beast, and we have a commercial lending division because commercial lending is kind of logical. It's balance sheet driven. It's pretty black and white. Residential, it's kind of like you're painting a Monet. It's like you're trying to, or you're cooking. Like you're just kind of, everything's an exception. It's outside the box, and you're trying to kind of make it fit. So yeah, it's yin and yang. And so we never encourage our res team to do commercial loans. We always encourage them to collaborate together, so that way the customer gets the best of both worlds, right? Gets a real professional who knows what they're doing.
Yeah. A professional who knows what they're doing, that's perfect for what I wanted to say, is that, we've been spending some time doing, financial planning, content here in the interviews that we're doing. Really introducing people to the idea that, getting some solid advice and building relationships with professionals can really make a difference over time. That you can actually have your borrowing and your lending and your planning all evolve with you as a person,
Mhm.
as time goes on. Um, we're going to be wrapping it up here. Are there any thoughts or any final thoughts that you have about, uh, you know, about having a mortgage broker or the Vine Group or anything at all?
Yeah, look, it kind of goes back to the beginning of the conversation, right? I think you want an advisor, not a processor, right? And that's what Line Group brings to the table. You want somebody who's going to be able to collaborate and work with all the other professionals within that customer's ecosystem, the accountant, the financial advisors, insurance, and make sure that we're all following the right paths to meet their long-term goals and objectives. And I would say to anybody, if you're talking to somebody about any kind of financing, and if the conversation revolves around interest rate, get a second opinion. Because the conversation should not be about interest rate. Interest rates don't vary much between one lender and another. The conversation should be about how much interest do I pay, and what support and what advice and what value proposition do you bring to the table as an advisor.
That's great. That's great. David, thank you for taking the time today.
Thank you, man.